Exchange-traded funds are something that everybody should consider getting. If you have no interest in the stock market, you should just park your money in an ETF over the long term. And even if you are very interested in the stock market, it is always a good idea to have a few exchange-traded funds and ETFs for the next 20, 30, 40 years as safe money that you know will accumulate over time. Welcome to the Max Invest YouTube channel, and we post daily financial videos. If you enjoy the video, remember to like and subscribe, and remember, nothing said in this video is financial advice, and you should always do your own research. We're going to start by talking about why and what exchange-traded funds are. What exchange-traded funds are is they are basically a pool of companies that you will buy into that directly tracks the market. So if you buy an exchange-traded fund to track the ASX market, you will get a portion of every little company in the ASX 200, and the exchange-traded fund will follow that over time. It's a very simple concept, and all they will do is follow a big pool of companies over time, so you're well diversified. The reason you would do this is it's very safe to follow a whole bunch of companies. If a few companies go wrong, it doesn't matter whatsoever. As long as business gets better over the long term, you are going to go very well. So with exchange-traded funds, all you are betting on is that business and the economy will continue to grow in the long term, and historically this has happened for the past hundreds and hundreds of years. So, the reason you would get an exchange-traded fund is to safely track economic activity in the business in the long term, and you are guaranteed to make money in 20 years. Maybe not in 1 or 2 years, however, in 20 years you will make money. As you can see, the US market has grown over time at an exponential rate. In the 1920s, the market was all the way down the bottom at this flat line, and as you can see on the diagram, it has kept going up. All of the grey lines represent pullbacks, so the overall market definitely can pull back. However, over time it continues going up and up. So if you just hold these exchange-traded funds, you will be guaranteed to make money. There has never been a point in history where the economy has not recovered for the US market. So you just hold these exchange-traded funds for the long term, and business will be better over time. In 2050 and in 2100, business is guaranteed to be better than it is now. And if you buy an exchange-traded fund, you will simply be a lot wealthier in that period of time. So that is why you should consider buying exchange-traded funds. You do not need to pick stocks. You don't need to worry about any of that. You just buy in, and then you walk away. You just leave it. You set the dividends to reinvesting, and you just leave these exchange-traded funds. The first exchange-traded fund we are going to look at is ticker symbol IVV. This provides access to the top 500 companies in the United States. So it provides broad market access to these companies, and as business does better over time and the top 500 grow, which they will grow, it will go better and better. It has a management fee of 0.04%, which is very low and means it should track the market quite well, and it's a $4 billion fund, which means it is very liquid and it is very safe. It pays a dividend of 1.84%, which should be roughly the same as the broader US market. Now, IVV is a ticker symbol for the Australian investors. You can simply get this from Australia. However, it does not track the market that well. It tracks it quite well, I should say. It does track it very well, but it won't do it perfectly because of currency issues and a whole bunch of other issues buying these US companies. SPY is the United States version of this. It also tracks the exact same companies as IVV, as I've just explained, and has a slightly lower management fee. This tracks it a little bit better as it's based in the United States. So if you're in the US, you can get this company, and this should do very well over the long term. The next company we're going to look at is IOO. This ticker symbol is the same for Australian investors and US investors. However, the share prices are different for a range of reasons. This has averaged 13% over the past 5 years, and what this basically means is the top 100 companies in the world are doing very well. The markets generally average 8%, so the top 100 companies tend to do better. If you buy into this ETF of the top 100 companies, what you're doing is you're betting that the mega cap companies, the biggest companies in the world, will continue to grow and continue to get better, which is a really strong conviction of mine, and I do believe this will happen. So I happen to own some IOO. It is $2 billion in net assets, meaning it is pretty liquid and quite a good fund, and it has a dividend yield of 1.33%. As you can see, it owns a lot of companies like Apple, Microsoft, Amazon, all of these massive companies, and it will track them going into the future. It would also own companies like Walmart and Alibaba. So this is one of the good ETFs that I believe in. Now, in the US, it's obviously the same ticker symbol, also IOO. All this will do is buy a slice of the top 100 companies in the world, and you'll track them over time, hold it for the long term, and you will be guaranteed to make money in 20, 30 years. Maybe not in a few years, it could go down. We don't know what will happen in the short term, but we do know what will happen in the long term. For the Australian investors, there is VAS. This tracks the ASX 300, S&P and ASX 300 index, so it tracks the top 300 companies in the Australian market. This pays a dividend of 2.3%, as Australian companies tend to pay a lot higher of a dividend than US companies, and it has a management fee of 0.1%. Still very, very low. It's a $7.45 billion fund started in 2009, so it is very safe and it is very liquid. It's started by Vanguard, one of the biggest institutions in the entire world, so this is quite a safe way to slowly track the ASX, and I definitely do have a lot of VAS. So this is one of the ticker symbols that I really do believe in, and I believe Australian business will continue to progress over time, and buying into the top 300 companies will do very well for me. Now, this last one, I've got a slightly higher growth ETF. This ETF is significantly higher growth than the last couple of ETFs I've said. It is called Asia. The ticker symbol is ASIA for Australia, and in the US you get a slightly different ETF. It's definitely different, but it has the same sort of idea and tracks the same sort of thing. And for the US, the ticker symbol is AIA. AIA. So this tracks the top technology shares in Asia, all of the top biggest Asian companies. It has management costs of 0.67% for this ETF, so it's more of a costly ETF. It is quite costly, however, it has generally outperformed the market significantly in the past year, doubling. It pays a dividend of 1%, so it has a small dividend, and in this ETF, 50% of companies are in China, 23% in Taiwan, and that's because Taiwan has a few massive companies like Taiwan Semiconductors, 19.9% in South Korea with companies like Samsung, and 5.7% in India. So as you can see, here are the holdings: Samsung, Taiwan Semiconductors, Tencent, Alibaba, JD, C, and a whole bunch of massive companies in Asia. These are the biggest companies in Asia, and this ETF will simply just track all of these massive companies going into the future and is likely to have some high benefits. I am very bullish on the Asian markets, as I strongly believe that Asia is a growing economy. We're going to see some massive growth in Asia, so I think it's a great idea just to simply hold an ETF of all these companies. You don't need to pick these companies or go onto the Hong Kong exchange. You can just buy an ETF in Australia and track the growth of the top companies in the Asian markets, which I am very bullish on. As you can see, if you're in the US, you can get a similar sort of thing with AIA. However, this tracks just the top 50 companies in Asia, so it's very similar. You'll have the same sort of stuff. Taiwan Semiconductors, Alibaba, all of these companies are in the top 50 in Asia, so you get the same sort of exposure with this for the US viewers. If you enjoyed the video, remember to like and subscribe, and remember, nothing that was said is financial advice. You should always do your own research. These ETFs are bound to do well in the long term. You need to buy them and hold them. You don't need to look at them every day. These are not your normal stocks. You don't even need to keep track of them. You can just tell your friends you just buy these, hold them for 20 years, and you will make money. There's no need to keep track of ETFs. You just get rich slowly. You're earning around 8% a year on average for 20 years, and you just get rich slowly. That's the way you do it with ETFs. Companies are obviously way more risky, but ETFs will provide you that safety. Thanks for watching.